Hello everyone, my name is David Varsimashvili. Are compliance regulations becoming so complex that they are killing the businesses? This compliance is no longer a side function. It's a core operational requirement. AML assessment is no longer just a regulatory requirement. It's a fundamental necessity to safeguard organizations from financial, legal, and reputational risks. Do sanctions work or not? The answer is both yes and no.
Hello, everyone, and welcome you to this episode of the webinar with Cezary. Today, we are going to talk about a very apparent problem, and that's what I thought that I invite my dear old business associate colleague Cezary to help us to shed some light about the differentiation of taxation versus the payments and the banking approach. What I mean is that today there are a lot of different tax advisors out there giving you different advice on how to optimize your taxes. But is it really what you want to do? What are the challenges? What are the dangers of implementing a tax optimization structure? And how is it going to affect your payment and banking setup? Cezary is here with us today to explain everything about substance, about nominees, about how to move your residence from one country to another. So I think that we are going to have a very exciting and interesting conversation, which is really affecting everybody today who is trading internationally. So thank you so much, Cezary, to join us here today at the Soltesz Institute. Can you tell us a bit more about yourself, and then what is your relationship to payments, banking, taxes, and how did you end up in this world?
Sure. Thank you, Victoria. Hello, everyone. Pleasure to be here. Thank you for the invitation. Always glad to work together on such projects. Very shortly about myself, I'm the international tax advisor, and I'm the founder of IBCCS Tax, which is an advisor firm with offices in Cyprus, UAE, Georgia, and Estonia. And in the firm, I'm mainly responsible for the tax advice, consultations, and the structuring regarding asset protection and tax optimization and similar things. So my background is accounting and tax, and I'm based in Cyprus. I would like to divide this conversation into three parts, so it gets more technical and so that our viewers can get more out of the webinar. I would like to divide it to first part, which will be related to changing the tax residency and discussing different tax risks, and then we'll have a small annotation related to the banking and what are the risks in regards to that. And the second part I would like to discuss is different tax risks when relocating your company or registering your company abroad. And third, I guess the most fruitful discussion I will have with you, Victoria, will be in regards to the banking system and how to open the bank accounts, where they should be opened, at what the viewers should look when choosing the EMIs, and of course analyzing all the different tax also risks when opening the bank accounts abroad.
Yes, and I think that every tax advisor once in their lifetime came across a request that someone called them and said that, hey, I'm sick and tired of paying so much taxes in my country. Why don't I just set up a new company somewhere in a country no one even heard of? I pay zero taxes. What stops me? I'm working online anyway.
Yeah.
If this was so easy, then I assume no one would pay taxes in countries when the taxation is very high. But obviously, there are so many more complexities to this. There are more layers that we need to unfold, and this is what we are going to talk about today in this webinar. But let's start about planning, because I think the first part that you mentioned, Cezary, about changing the tax residency of an individual is a very basic requirement, even for a company, because obviously companies are run by individuals, directors, shareholders. So let's jump in and tell us why we need to plan, how we need to plan, and of course, why this first step is absolutely vital when we are building a strategy for a company.
Sure, definitely. As you have mentioned, although it's a basic topic, it's actually a very complex topic because it involves analyzing your situation or the situation of the client cross-border. So in the country from which he is moving and in the country where he is moving to. And there are definitely a bunch of factors that have to be considered. I would like to start with a small advice to the viewers, and I'm sure you will agree with me on that. Because many people come to us and they're like, okay, we want to change tax residency. I've read this on the internet, and my neighbor who moved to Cyprus or to UAE or to somewhere, he told me that I can do it, and there you go, I'm with you. We always advise our clients so that they use the services and the relevant advice of the local tax advisor or local lawyer specializing in tax from the country where they currently reside. So if we're talking about the Hungarian citizen relocating to Cyprus as an example, we would always advise the client to get the relevant advice of even what we will advise the client from the Hungarian tax advisor. Because in this case, first of all, the client feels secure in terms of any local legislation risks. And let's be honest, nowadays it's very tricky and quite complex in most of the developed countries at least. And second, it will also make our work easier as the local advisors in Cyprus or international advisors, because we'll be already knowing the full situation of the client. So I'm sure, Victoria, you will agree with me on this. Maybe you can give a comment of how you guys deal with these things.
Yes, usually what I have is that I'm a freelancer. I started to live in Cyprus, and then what are the steps, which is easier because if the person is living in Cyprus, it's obviously much different. Then the very common request that, I'm sick and tired of paying so much taxes, let's say in Hungary, and I just want to incorporate the company in Cyprus, but I still want to keep my work, my other business. I still want to, pay some taxes in Hungary after my other affairs, but I just want to set up a Cyprus company for tax optimization purposes. We are in the EU. No one is really checking where do I live anyway. And this is when I obviously get involved and say that unfortunately it doesn't work like that, because as we said, that if it was so easy, no one would pay taxes in Hungary, in Germany, in Spain, in other areas in the world. So that's, I think, the most important thing, that even if a tax setup is allowing you to do so, because there are still some countries where you can go and incorporate a company, even though that you are not a resident in that country, you will have problems with banking and payment, because the banks and the payment providers are made to filter out those creative individuals like you, right? So the whole idea is that even though that you are allowed to do certain things and you are not committing a crime, legally it's possible. Even your tax advisor is telling you that, yes, this is fine. You will, or you might face some serious difficulties when it comes to payments and banking, and the risk and the cost aggregated might be even higher than the tax that you would have just paid if you stayed where you are. But I'm very curious about your opinion as a obviously tax advisor, that how do you deal with these creative individuals? What are the soft requirements when it comes to moving residency from one country to another?
Look, as I mentioned, I totally agree with what you said. First of all, this is a great example of a client, always knowing what they want. But our approach is quite simple. We specialize in international tax, and we specialize in the jurisdictions where we have offices. So we always tell the client, okay, if you reside in Germany, it's best if you confirm the plan that we'll do for you with your German tax advisor, or maybe even have the German tax advisor on board. So I'm always fan of having conversations with tax people and lawyers, because they also kind of guide the client in what direction he should go and in what direction they shouldn't go. Because when the client comes to me or you, Victoria, we have no idea who these people are. And usually the lawyers, they will give us a very decent information in the structured form. So definitely this is one of the first steps. If you don't mind, I would like to have a discussion about the steps that one needs to take to change the residency, at least from the technical and tax perspective, and also relating to double tax treaties. So the most common question from our potential clients is how to change the tax residency. What should I do in order to remove my residency, let's say in Hungary or in Poland, and get my residency, let's say in Cyprus? So first of all, we need to make sure that we meet the domestic requirements, the local requirements of the country to which we're moving to. For example, in Cyprus, you need to spend at least 60 days per year. You cannot spend at least 183 days per year in the other country. You cannot be a resident of the other country. You need to have some source of income. And there are also some local, let's call it legal requirements, like making a residency card, having the rental agreement, and having some substance. But you also need to make sure you meet the domestic requirements of the country that you're living. So in case of Poland, for example, because I know the legislation very well, in Poland, the tax residency test is 183 days plus, and also having the center of vital interest. So when we are changing the tax residency from Polish to Cypriot, then we need to make sure not only that we are going to spend 183 days plus in Cyprus, or 60 days plus in Cyprus, and not spending 183 days plus in Poland. We need to make sure that we have center of vital interest here. And even though, technically speaking, we'll go through this now, even though technically speaking, when we have a cross-border inspection, the only relevant document that is valid is a double tax treaty between the countries, we still need to take care of the local tests, because at least in the first year of changing the residence, they're the most crucial. And of course, if you don't meet the tests in Cyprus, then they will not give you a tax residency certificate and you won't be able to get the residency. So one more time, first we should take care that we comply with the local regulations of the Cyprus in this case, and we comply of the regulations of not being a tax resident of Poland in this case. But once we do this, of course, depending on the legal and tax status, and depending on the history of the taxpayer that is moving, let's say, from Poland to Cyprus, we might have inspections. It happens very often because, as you know, Victoria, and as the whole industry knows, there are many people that are changing their residency on paper and they're not really meeting the requirements. So thanks to this, because of this, sometimes there are inspections happening cross-border between the tax offices. And if there is a cross-border inspection and the country has a double tax treaty, the two countries have a double tax treaty, we should disregard the local regulations and we should only consider what double tax treaty says. In order to analyze the residency of the taxpayer if he is moving from Hungary to Cyprus in this case. The first test that the tax authorities are checking is called permanent home. And this is very simple. You basically need to prove that you have a home available to you in relevant country. So if we are moving from Hungary to Cyprus and we have rented or we have bought a house in Cyprus, we shouldn't have permanent home available to you in Hungary. And this is quite tricky because if the tax authority is aggressive, they might even consider having permanent home not as the property that the taxpayer owns, but let's say as the property of his friends or parents or lover or whatever. So we just need to prove that we have this permanent home available to us in Cyprus, and we should prove that we do not really have this in the other country. And this is the most difficult to be proven. So usually the tax office is going to the next step, and the next test is called Center of Vital Interest. And Center of Vital Interest is a very broad topic because it's an infrastructure that relates to the person and it relates to both personal and social life and also business life of the person. As an example, the Center of Vital Interest can have such elements as where your kids go to school, where you are employed, where is your business, to which social clubs do you go, and so what does your wife do, where is she doing this, etc. So it's a very broad term and it cannot be analyzed very easily, but the best way to actually analyze it in case we have the inspection is the comparison. So if we move from Hungary to Cyprus, then we compare how much in common we have in Hungary after we have moved in and how much in common we have in Cyprus. So if we rented a house in Cyprus, if we registered the company, if we got employed, if we go to the gym, if our kids go to school in Cyprus and we really live here, but in Hungary we have left everything, we have no business, no properties, kids are not there, we don't come back to the country very often, then we can be pretty sure that the Center of Vital Interest is in this case in Cyprus. So what happens next? If the tax authority is very aggressive and it's pretty sure that, okay, you might have Center of Vital Interest in both countries. So the next step is called habitual abode. And habitual abode is also a very funny test because it deals with frequency of the visits to the country from which we moved. So in this case, if we live in Cyprus, if we have permanent home here, if we have a family, if we have a business, but for some very important to our life and to our income reason, we go back to Hungary, let's say for 3 days a week, for 1 day a week on the regular basis, or we go every month for a couple of days, then if this reason is important enough for our overall tax situation, then it might be considered that we have a habitual abode and tax residency in Hungary in this case. And if both of these tests fail, then we have a test of the nationality. So as you can see, it's not very easy in terms of proving to the tax authority, and there are a bunch of elements that one has to consider when moving. So we need to make a very careful choice, and we cannot just go from one country to another and start a life there and think that we'll have tax residency in the other country.
I agree. And actually, we had a case a couple of months ago when there was a Hungarian individual who said that he wants to incorporate a company in Cyprus, but his children went to school locally, right? We are talking about underage children. His wife was working as an employee in a Hungarian company. He had properties in Hungary. So that was really challenging to even explain to that individual that just because you as a person decide that you start a new life and then start a new company company in Cyprus, even though that you rent a permanent residency for yourself, a permanent home, as you mentioned, or even if you've got, utility bills on your name in Cyprus, there could be still the Hungarian tax authorities question this. That how comes that you've got wife, children, properties? As you mentioned, all of these central of vital interest is in Hungary. And then you just happen to move one side of your business to Cyprus and then claim a Cyprus tax residency, therefore pay less tax. So it's never Cyprus who is going to question this. I mean, obviously, Cyprus authorities are happy. We've got a new taxpayer. I'm not going to say no to money. Welcome here, of course. Come and spend your money. But as you said, the origin country is the one who is challenging all of that. And the Hungarian tax authorities in this example can ask that, well, how comes that you live in Cyprus and then your family, your properties, your other businesses are still here in Hungary? So it's very easy to fall in the trap of those Instagram tax advisors telling you that, yes, just come here, spend 60 days in Cyprus. You don't even need to spend more than, 60 days, 2 months in Cyprus and you're good to go. No, it's not that easy. And the reason why it's not that easy, because otherwise everybody would have done that and no one would pay taxes in high tax bracket countries. So completely
actually
agree with you.
reminded me about a story of how a client was caught. I'm not going to mention where and by what country, but the guy was driving a Ferrari. He bought a new Ferrari from his Cyprus company, and he was also trying to have his residency, but he didn't really live here. And the neighbors submitted an application because he was showing off to everyone, like, oh, hi, look at me, I don't pay taxes in Poland now, or in Hungary, or in Germany, whatever. I'm so cool. And he was so cool until maybe a month later, where he got the inspection, and of course he lost because he almost never stepped his foot in Cyprus. So it's also a very cautious move that you have to consider when you are changing the residency, especially if you are risking that you are not going to potentially meet the requirements, which of course we don't advise. Then you just have to be very careful. And even if you meet the requirements, in case that Victoria mentioned that the Hungarian resident was, having all his substance, let's call it, in Hungary. First of all, this is a clear case of having a center of vital interest in Hungary, and I'm pretty sure that if he didn't face the consequences, maybe one day he will. But second, if this guy is not very cautious of what he is doing and where he is doing that and to whom he is showing off, then this might result in serious issues.
Yes, we will want to avoid audits, but obviously, even if the audit comes, you have to prove that you did everything as you should, to be ethical, transparent, and obviously follow the rules. I usually say that if it's obvious, it's going to be obvious for the tax officer as well, right?
Definitely.
So it's not like idiots are working in a tax office. So if it's something screaming out loud, obvious that you are just having a Cyprus company just to optimize your taxes, clearly it's not going to fly. So of course, the first line of defense is the banking. So you first need to convince your banking providers and payment service providers that you are not living in Cyprus just to optimize your taxes, or you're not living in Dubai just because you like the 0% taxation. It's because you live there, you go, as you said, to the social club, you do your groceries, you breathe the local air, you walk on the local floor, and that's the reason that you live. And then it happens to incorporate the company, and then lucky you, the taxes are lower in that country, and that is what justifies that. So it's important, as you mentioned, step one, the person who is actually moving to a new country, that's the vital center of any kind of tax ruling, even when it comes to companies. So tell us about the next step, right? So once we've got the person is moving to a new country, really moving to a new country, all of his interest or her interest is now related to the new country, starts a new life, gets a house, starts to do business. What's next? What's the next step of like incorporating a company and how that company becomes resident in this new jurisdiction?
Well, the next step is the most fruity one, which is opening of the bank account. Maybe let's have a quick discussion about that before we go to the company, because it's also a crucial topic when you change the residency. So, as you know, there is CRS, the exchange of information between the jurisdictions and the banks. It works very well for the past, I believe, more than 10 years. And the most common mistake is when the client is changing the tax residency and moving, let's say, from Hungary to Cyprus. When he starts to open the bank account, even maybe before moving to Cyprus, he is including the place of his residency as a Hungary, and he is giving the Hungarian address to the bank, which is a very big risk because there is CRS based on the automatic exchange between Cyprus and Hungary and also in the other jurisdictions. So if this person gives a wrong address, it means that this bank where he opened the account, in this case Cyprus, this bank will exchange the information about his account balance and if he has any companies in this bank, if he has an account here, how much money he has, and this bank will send this information to a tax office in Hungary in this case. So it's very important once we change the residency to update the banking details, and this goes with, it disregards the jurisdiction of the bank. So wherever CRS exists, you should update your banking details, the addresses, to make sure that the EMI or a bank really applied your CY residency and not Hungarian residency, because I guess we don't want Hungarian government to know how much money we're making once we move to Cyprus.
Technically, they know it anyway because there is a free flow of information even within Europe, but even outside of Europe. I think the classic case for this was back at the early 20th century when money started to flow out of America and the drug cartel started to siphon some money out of America and started to incorporate companies in the Caribbean region and in Latin America. And that's why this whole anti-money laundering and tax evasion policies were implemented into the banks, because if you follow the money, you can figure out that who is trying to cheat their way out of the system and how they start to incorporate companies in certain jurisdictions, open a local bank account and transfer all those monies there. So if you think that just because you open another bank account in another country, let alone in outside or inside in EU, your tax authority can have the capability to find out all of your balances and all of your affairs. So it's not just, I've got the Hungarian account, only the Hungarian tax authority is going to see that. I've got the Belgian account, only the Belgian tax office is going to see that. Nowadays, the banks are unified in a way that if someone is typing your name and passport number and obviously tax residency, then they have the full capability to screen everything, and that stops criminals to not to declare certain things on their tax return, right? So if I say to my Cyprus tax authorities that I only earned 10,000 euros per year, but on the side I've got a Belgian account, a TransferWise account, or even an offshore account, a Dubai account, for example, with millions and millions, those banks still have the requirement to declare all of your transactions and bank balances to your tax authority. So if you think, so the bank is basically the first line of defense to filter out all of that, because you follow the money, you follow up that who is trying to cheat the system. So let's go down now. Yes.
I believe you're also mentioning these things in your book that is beautifully sitting behind you, right?
That's right. So it's all written in the Moving Money, How Banks Think.
Cool, very cool. So if nobody has read the book, please read it, order it. It's a very interesting book, and it could probably give you all the information in regards to how banks think and what to expect when doing banking in general.
Thank you.
So you see, I made you a small advertising.
Thank you. Great.
So just to close the first topic in regards to the personal tax residency, one more thing I want to mention is we also get these questions asked quite often. If I need to have a local bank account when I move to Cyprus, because in Cyprus, with all my love to this island and tax authorities and everything else, let's just say the banks are not the most friendly in all the world, and it's probably not advised to keep tens of millions here. I'm not saying I wouldn't recommend to have the bank account in Cyprus for different cases, but to answer the question, yes, it's always better to have the bank account in the country where you reside.
Everyone, my name is Viktoria Soltesz and I'm the founder of the Soltesz Institute. Startups fail, and if they fail, most probably they are failing because they don't have the thought out and proper channels for payments and banking.
Hello everyone, my name is David Vartsimashvili. Compliance is no longer a side function. It's a core operational requirement.
Welcome everybody. I'm Marcia Klingon-Smith. Instant payments is transforming the way money moves all across the globe, across all the different industries.
Yes, it's always better to have the bank account in the country where you reside. First of all, it gives a small element to the substance, a very small one. But most importantly, it will make your life easier to deal with paying social insurance, paying taxes, and maybe making a standing orders on your utility bills. So it's not an obligation to have a local bank account, but it's recommended and it's also useful. Again, I'm pretty sure your clients and everyone on the internet has a basics of how to register a company, maybe where to register a company. But in this webinar, I would like to discuss the technicalities, what a taxpayer should consider when registering a company abroad and what tax risks exist. Because as you mentioned, Victoria, previously, there are a bunch of people that just, they register a company in Cyprus, in Dubai, in Marshall Islands, offshore, being the directors, operating from whatever countries, and they read on the internet that they register a company in Dubai, you'll pay zero tax, or register a company in Seychelles, you'll pay zero tax, which is partly true, but in general, it has a very big risk. So I would like to touch this amazing topics, and the first topic that I would like to start is regarding the tax residency of the company, actually, because not only the individuals can have tax residency, there is also tax residency of the company, which establishes where the company is paying taxes. And this depends on the jurisdiction of the country where we incorporate. For example, in Estonia, you have the principle of incorporation by default, which means that if the company is registered in Estonia, by default, it pays tax there, no matter who is managing it and how, by default. In places like Cyprus, we have at the moment, two rules. We only used to have management and control rule, but recently the incorporation test was added. So it's mixed, but still the main prevailing rule is management and control principle, which means that if we have a Cyprus company and it is managed and controlled from Cyprus, which means that the director of the Cyprus company has to take a decision or a resolution or decide from here, then in this case we have a Cyprus company being a Cyprus tax resident. But in theory, if a Cyprus company has, let's say, Polish director, and this director is managing the company from Poland, we have a risk that this company can be a tax resident of Poland. And these are the main two principles, incorporation principle and management and control principle. But in double tax treaties, usually we have a different test. So if you register a company in Cyprus, but you're based in Hungary, and you're operating everything from there, you're supervising the processes, managing the company, clicking the buttons in the brokerage account, making bank transfers, and doing this basically, then you might have a risk of having the tax residency in the other country, in Hungary. And what that means, it means that the Cyprus company should pay taxes in Hungary on all the income that relates to this residency. That's a bit scary, but it's true.
Great. So I think
it depends for whom.
Yes, of course. Because if you think about it, you need to prove that you are working as business usual, but just you happen to work, lucky you, in a country whereby the taxes are lower, but you're not intentionally shifting all your operation in a way that you are basically reducing your tax rate, because that's the very thin line between tax planning and tax evasion. Tax planning is that you are really working in a country, you are really living in a country, you're really exercising the management and control or the active involvement in a company. You are just lucky to be in a country where the taxes are lower. Versus tax evasion, when you are setting up a company just for the purpose of cheating taxes, just in order to pay less taxes, just to get yourself out of your responsibility of paying taxes wherever you are based. And I think you've got a very interesting case study for us. Maybe you want to tell us a bit more about what happened with that client who was trading stocks in Cyprus, but he did it from Hungary.
Yeah, definitely. I mean, the story ended tragically, unfortunately. The story ended in the way that the client had to register himself to a tax office in Hungary and basically tax all the operations that he had. I mean, maybe not all the operations, because in this case they have applied permanent establishment and not the residency of the company, but it ended tragically, and this scenario can basically happen to everyone. And now there will be a question of, okay, how we can mitigate this. It's actually very easy. So in case, for example, when we have a client with the CY company that where the UBO is from Hungary, again, we love Hungary in these examples. If the UBO is Hungarian, and let's say the Cyprus company has a brokerage account, even though we have nominee director or real director based in Cyprus, but if the UBO is performing all the transfers and the director in Cyprus has no access to the accounts, no controlling power, no financial or executive power, and the UBO from Hungary is operating the brokerage account, trading stocks, crypto, forex, whatever, then this is a clear example of not having the management and control, of having place of effective management in Hungary, because this UBO is actually doing all the business from his computer, and this company in Cyprus exists only in paper, and it's also a proof of having permanent establishment in Hungary. It's a bit unofficial because there is no agreement whatsoever, but if it's proven that the UBO based in Hungary was, performing all the brokerage, etc., and there is no substance in Cyprus, then we might have a problem. So the first advice to everyone is make sure your Cyprus director, in this case, have enough of power. Make sure he has access to the bank accounts. And if we are talking about crypto wallets or brokerage accounts, then of course the best solution would be to have the CY director having access to them. And many of the clients are scared of giving access to the directors or to service providers, whoever is operating the company. But there is a solution for that. Usually when the cross-border inspection starts, we do have this sometimes, especially from the Polish or Belgian or Norwegian authorities. Then there is a list of questions like, does the director get paid for his duties? Does the director have access to the bank account? Does the director have access to the brokerage account? Does the director has a single signatory power, or the UBO has to confirm? There are a bunch of questions basically regarding the banking power, let's call it, of the director. Then in the questionnaire from the Norwegian tax office, let's say, we will say, yes, director has access to bank account. Yes, director has executive power. Yes, director is getting paid.
Exactly. And that's when it gets to show that payment and banking strategy and planning has to be at the forefront, even before when you incorporate a company. Because oftentimes we have seen that there is a company with a good innovative idea, they even raised funds, they started to develop their application or their platform or the product or any kind of services that they are about to sell. And then maybe they talk to a tax advisor or not, they grow, they become international, multiple companies belong to the group, and that's when they start facing payments and banking problems. And it's so much harder to find payment and banking providers to fit your specific need with your specific setup. Then plan for the payment and banking strategy at the beginning. Start planning your operation around the requirements of the payment and the banking providers, and then run your business based on how can you collect money from your customers, how can you pay your suppliers, what are the fees, what are the risks. And in this way, maybe there could be some contradicting advice from your tax advisor or from your payment and banking advisor. Because as you said at the beginning, just because legal, it doesn't mean that banks will also support it. But this should be the very forefront of your strategic planning to set up all the rails and all the understanding that what your payment and banking providers need and require from you in order to work with you. You mentioned nominees, and I would like to, pick that a bit further. What do you personally think about nominees? Nominees are legal, so nominees are those directors who we are appointing to represent the company in the place that we just incorporated the company, and the actual directorship, the actual management is some other country. So it's a very controversial topic. Do you think nominees are a benefit, a risk, a problem? It's an overseeing from the tax authorities' perspective that they still allow fiduciary companies to advertise for nominees. Many times, for example, the banks understand that this is a nominee and they want to really see who is the real director and then ignore the nominees.
Yeah.
What do you think about it? Who are these nominees and why they are important and also risky?
Well, I totally agree with your comment. It is legal, it is regulated in many countries, but I think long term, if we are doing business, it's probably not good to use nominee directors or any nominee services. Because first of all, it is much more difficult to open bank accounts, let's say if you have a nominee shareholder, than when you are the shareholder directly. And second, it's not perceived well by the tax authorities and by the banks. Nowadays, even EMIs are asking for like employment agreements, rental agreements, and the information if the director is a nominee or not. So it's quite tricky. I definitely think that this industry of nominee services is shrinking, and it will shrink more because there are more and more regulations, and the whole trend is changing more from offshore companies towards physical relocation and physical doing business. But on the other hand, these services are legal. Nobody can prohibit using these services, and sometimes, very often, actually, it makes sense, especially if somebody wants to protect their identity and sometimes protect their assets. It can be advised to use a nominee structure. Not everyone wants to be so transparent, especially if we're talking about wealthy people and serious businessmen. I think privacy should exist, and I believe nominee services should exist so that we can execute privacy and so that also we can help the clients to do business in the easier way, because it's not only a matter of using a nominee service. If you want to open a business fast, if you need people in the other country to start the business, you would probably first go to a law firm, get the nominee director, tell them what's the plan, start the business, and maybe then the UBO or employee or somebody would take over. So I'm curious, what is your opinion about that, actually, about the future of the nominee services and privacy? And maybe you can tell us how does it reflect to the banking sphere?
Actually, we had a client who was doing the obvious, went to a new jurisdiction, incorporated a company, and hired a nominee. And little he knew that nominee person was also a nominee director for multiple other companies as well. Usually, nominees, that's how they earn money, that's their main line of business. So that nominee in question was also a nominee for about 10 or 15 other companies. And of course, as it happens, things went wrong. One out of that other 10, 15 companies that he was also a nominee for did something stupid when it comes to banking or payment. They did not pay attention to their chargeback, or there was some kind of other issue which resulted the whole company to end up on the fraud list, the international naughty list. And because my client shared now a nominee director who is fraudulent, now his company became automatically fraudulent from banking and payment perspective, because the director was flagged, his company, because it's under the same directorship, was also flagged. So that is the risk that you are facing in case that you are using a nominee director. And what I noticed that quite recently banks started to check that how many other companies that director is also a director. And I think that there is also a regulation in certain European countries that you cannot be a director for more than 5 companies at the same time, because then you have to register yourself as a nominee service provider. And then it's obvious that you're a nominee. So why would anyone want to work with you? And in this case, the banks need to also check that if you are a director for this company and for other 5 companies, how can you exercise management and control? How can you make the relevant decisions? Obviously, then you're a nominee. Then we need to understand who is the real person behind the management and the control. And if that person goes back to the original cases, as we mentioned, is living in Poland or living in Hungary, then we go back to the original scenario when, well, you're actually exercising your management and control rights from a different country, and then the different countries, the original countries, tax authorities have all the opportunities to catch you and say that, well, you're running a foreign operation with the nominee director, you just want to avoid taxes, here is the penalty and all of the investigation on you. So in this case, I think that the nominee setup is a bit tricky. I agree with you that we do need to have privacy. However, the privacy has to also cover some kind of setup that even without a nominee, that would be legit to pay taxes in the new jurisdiction. So it cannot cover someone just to verify that the company is in new jurisdiction, and that's why they need to pay less taxes. So yes, it's a very interesting and controversial kind of subjects around nominees. But I think banks are implementing much stricter rules than even tax offices that I have seen, because the tax office might just miss out on tax, but the banks and payment institutions get really bad penalties and repercussions in case that they allow anything. There is a slight opportunity for tax evasion or even money laundering. So as we have seen, banks and payment institutions, oftentimes they got really bad penalties. So that's also something to keep in mind, that the banks have more to lose here, and that's why they are enforcing the rules much stricter.
Yeah, which brings us to the topic of substance. I mean, even with the EMIs nowadays, as I mentioned before, many EMIs started wanting uh, to receive the rental agreements, utility bills, employment agreements, which is a kind of an answer of what's happening with the non services. Because if we need employees in the company, then the money services kind of go away, which I guess for the countries and the economies by itself, it's a very good benefit because people pay taxes, people pay social insurance, there is more spendings, people buy properties. Um, yeah.
I also wanted to ask you about the data sharing between banks, because we established that banks are working very closely with the regulator,
Mhm.
and that's why they have to submit different reports about who is keeping money with them, how much is it, and what are the transactions. But when it comes to e-money institutions or payment institutions or these lighter banking, quasi-banking licenses, the financial licenses as a wallet
Mhm.
provider or any kind of crypto exchange, for example, do they also share information to the tax office in the same way as banks do? And if not, why? And if they do, is it not just too much to deal with? What is the requirement around that?
Yeah, that's a very good question. Thank you for that. The answer is it depends. Obviously, there is CRS exchange of information, and there are a couple of other legislation that govern banks. So we know that banks, if they're in the legal framework of the relevant law, they do exchange information. EMIs depends what is their status. Technically, they should, but in practice, they usually don't. And especially if we have the EMI that are offering common IBANs, then it's impossible to share the information. If the EMI offers direct IBANs, then technically they should be responsible in some way, but the practice is that nobody is sharing the information. It doesn't mean that they will not, especially they will not based on a request. So if a request comes from the tax office, let's say, they might share some information if the legislation allows. But at the moment, most of the EMIs they don't. But we also might have situation that happened with Revolut. Revolut was an EMI in the past, and they converted the EMI to the bank. So the EMI became a bank, and they started sharing the information. So I think looking at the long-term development of the EMIs, they will be sharing the information, whether they become banks or not. And seeing what's happening in general in terms of transparency internationally, I'm pretty sure that the governments will come up with some new rules in regards to the exchange of information. You have mentioned also PSPs, payment gateways, crypto wallets, crypto exchanges. Well, these are usually not financial institutions, and this, even if they are, they're not offering bank accounts. So in case of PSPs or crypto wallets or payment gateways or stuff like that, then usually the information is not shown to the tax authority. It doesn't mean that the information will not be shown if there is a court order, let's say. But again, it's a very difficult situation, and in practice, the success rate of for the tax officers or even for the courts requesting the information from the crypto exchanges or even EMIs or PSPs is very low.
And before we wrap up, I'm curious about one more thing. What do you think all of these technology, fintech innovations, AI,
Mhm.
how will it reshape the world's international taxation rules? Now we see that different countries apply different rules, different tax regimes. But now everything gets more and more unified, more global.
Yeah.
We are going towards international payments in a heartbeat. How do you think that the differentiation of the tax systems will catch up with all of these new innovations, when AI will be filtering out really quickly that who is paying how much tax in one jurisdiction? Will we see and will we go towards a unified tax regime globally, or you think that there are still arbitrage opportunities here dealing with different jurisdictions and different tax rates?
Yeah, that's an amazing and very tricky question. Look, I think all world, if we're discussing the governments at least, is going towards transparency, exchange of information, and paying higher taxes in general. There is an idea of the unified taxation, which in my opinion cannot work. Maybe the governments can adjust their tax rates to more similar than others. But I think the whole concept of the unified tax rate is impossible because every jurisdiction is different. We have different development of the jurisdictions. There are many criteria that will prohibit to have the same amount of tax. Imagine comparing Kenya with Germany and Switzerland. Totally different places, totally different economies. It would be impossible to say, you know what, let's have a 15% tax rate for all these three jurisdictions. So I think we're striving towards more unified taxation, but I think it's impossible. But you have mentioned, you have asked a question about what I think, what will happen with all this AI stuff. Well, it has two aspects. The aspect number one is when governments will start implementing AI, it will be super easy for them to find any errors, to find tax avoiders, tax evaders, and to point out all the mistakes by the tax office. I mean, I think a great example of that is the Federal Tax Authority of United Arab Emirates. I mean, I can't say much because obviously I cannot say, I haven't been there, I haven't made audit of their IT staff, and I don't know for a fact many things, but I have heard, and this was confirmed by some events, that they are using a lot of modern technology. They have algorithms checking things. They have blockchain technology implemented. They have AI robots checking certain things. In this case, it's very easy to find out a mistake. And if governments will do that on the global scale, it will prohibit all the taxpayers from avoiding taxes and from making, funny schemes, because the government with one algorithm will be able to make an inspection. They will say how much the turnover your company made, how much cost you had, how much tax you paid. 1 million turnover, 900 costs, something else, I paid zero tax. What the hell? And I'm sure there will be many inspections. But we also have a problem of the tax authorities taxing online businesses, because now, as you have mentioned, world is going towards AI. There are many AI businesses that's pretty much working on their own, and there is a global problem in the tax offices that they don't know how to tax the company, because who is making decisions? Where is the permanent establishment? Is it the place of the server? Is it the place of the registration of a company? Is it the place of the location of a director? What if the owner just set up a company, create an algorithm, and the robots are doing everything for them, and the robots are hiring another robots in the other countries? So I'm sure it's going to be a huge challenge, but long story short, the result should be more transparency and less crimes.
Exactly. We are all
That's what I
moving
think.
towards a more ethical and transparent industry, and taxation is just one part. Banks and payment providers are the ones who are making sure that this system is kept in place. Is there something that we haven't talked about, but you think that we should mention?
I believe no. I mean, we can obviously have ongoing conversations about company setups, about where should I open bank account, which bank to choose, what is my risk, this and that. But I think it's for the viewers, it wouldn't be a right move to do because the topics are too broad. So of course we're invited for cooperation, and I'm sure you will agree. We will be very happy to help anyone and meet in Cyprus, in Dubai, in Georgia, in Bahamas, wherever you are at the moment.
Exactly. And I would like to encourage everyone who is having any questions regarding taxation, regarding payments and banking, regarding company incorporation, that please do reach out to us, because that's what we are advocating for in the Soltesz Institute, to get the decision makers closer to the users, to get the banks closer to the online businesses, to talk about these compliance problems, risk, prices, and the whole approach, because that's the only way that we can make payments and banking much easier and much more transparent, and obviously taxation is more ethical for everyone. So thank you so much, Cezary, that being here with us today. Really appreciate
Thanks a
it.
lot.
And
Pleasure.
please share some information about where can we find you, how we can reach out to you.
You can find me in Cyprus or in Georgia or in Dubai or in Estonia sometimes. I think the easiest way is visiting our website, ibccs.tax, or of course, you can find us through Soltesz Institute and Viktoria.
That's right. So thank you so much for everyone who was joining us today. Thank you very much, Cezary. It was a pleasure. Thank you.
Thank you. Take care. Ciao.
Hey, welcome everybody. I'm Marcia Klingensmith. Instant payments is transforming the way money moves all across the globe, across all the different industries. A recent study showed that 42% of instant payment transactions actually happen on the evenings and weekends. About $200 billion is currently locked up in the European financial system today. And instant payments really can help unlock this liquidity. The future of finance is instant, and those who adapt will thrive.